your screen, you'll see that there is a chat function. And so if you click on the chat box, you'll open that up. And this is your way to communicate with us, who are the hosts and panelists, as well as your other colleagues who are joining the webinar. We ask that you use the chat box to certainly share messages, information, links. That is a great place to chat, especially if you like an idea. That's a great place to tell us, or you have other experience in a similar area of climate finance. That's great. Right now, if you want to check out your chat function, we would love for you to say hello to us and tell us where you're calling in from today. Great to know the spread of folks who are joining us for today's webinar. The other tool that we're going to be using today is called Q&A. And so if you have a question for one of the panelists, we would love to have it. We're going to have a series of presentations, and then we're also going to have a Q&A at the end, moderated by Sashi Jayatileke from USAID. And so if you submit your questions there, we'll put them in the queue and try to get to as many questions as we can today. Any questions that we don't get to today, we're going to do our best to answer and post as FAQs along with a blog on this same topic on the Climatelinks site. And so again, thank you so much for those of you who are logging in early. We are delighted to have you with us. If you're here for the Climate Finance webinar, you are in the right place, and we have a great slate of panelists ready to chat with you today. We're going to get started officially at 8:30 Eastern Time. And as folks are logging in, I'm going to repeat a couple of messages. So if you're here early, apologies for some repetition. First of all, we're just delighted to have you with us. And second of all, we want to make sure that you're familiar with the webinar tools we'll be using today. We really would like you to take advantage of them. The first one, if you go down to the bottom of your screen, it may be hidden. And once you hover down there, you'll see chat. You'll want to have that open. That's a great place to send us messages, to chat with other folks who are also in the webinar, to tell us if you like an idea, or to share links if you've got similar ideas or information on climate finance that we have today. So the chat is a great place to be. And in fact, if you want to try out your chat functionality, if you would click on chat, open it up, and you can send a message to everyone in the webinar by clicking everyone and let us know where you're dialing in from today. We would love to see the spread of folks who are joining us. We know that a bit over 200 people have registered, and so we're really excited to have that great group with us today. The other feature that we're going to be leveraging is called the Q&A function. And so similarly, if you go down to the bottom of your screen in Zoom, you'll see that Q&A has two talking bubbles next to it. If you click on that, there you'll see a place to submit questions. This is where we'll be taking questions that will be answered during the panel. We'll do our best to answer as many questions as possible. And any questions that we can't answer, we'll do our best to follow up on and post those responses so that you can have access to them. And so again, thanks for joining us early today. If you're logged on early and you want to get some coffee, tea, or water, our webinar team is doing the same thing as we get ready to start in about 5 minutes. You're also very welcome. If there's others who would like to join the webinar today, they can, of course, register last minute and hop online with us. We are streaming live on YouTube and several websites, including Climatelinks today. And so anyone and everyone is welcome to join us for today's webinar. And so Glenn and Ignatius want to say thank you to you all for logging in early. Really appreciate it. Glad to have you with us today. Welcome to Brad. Nice to have you with us too.
Hey, good morning.
Good morning. And welcome to Penelope. So glad to have folks joining in. Welcome, Leslie. Nice to have you with us. And if you are here today for the USAID Climate Strategy, Climate Finance topic focused webinar, you are in the right place. We've got a great group of panelists from USAID and other organizations joining us today. We're so delighted to introduce them to you shortly. We are going to get started more officially at 8:30 Eastern Time, and so in just 4 minutes. And so thanks for logging on a bit early. As folks are joining us today, just want to say hello to some new folks, Stein and Satish and Max. Nice to have you with us as well. We just wanted to alert you to a couple of the features we'll be using today in our webinar. And so down at the very bottom of your screen, if you go down there and hover, a bar will pop up with some features. And so we would appreciate today if you use the chat to send messages about the topics that we're talking about today, so share a place to share information, things like that. The other feature that we'll use is called Q&A. And so if you have a question for any of the panelists, please submit your question there. We'll be organizing those to respond to in Q&A, and the questions we can't get to today, we'll do our best to follow up on. Excellent. Great. Thanks, Satish. Thank you, Max. Nice to have you all with us too. So in the chat box, if you've logged on early, I want to say hello to a few more folks joining. So Ademola, nice to have you with us as well. We are just getting started. And so if you open up your chat box and want to share where you're calling in from today and what organization, that would be great. It would be lovely to hear the spread of folks. We know that we've had over 200 people registered for our webinar today. And so we're so delighted that so many folks are interested and talking about climate finance. And welcome to Bill. Nice to have you with us too. And great, so nice to see how many folks are interested in this topic. We are going to get more officially started in about 2 minutes. Oh, great. Thanks, Max. So calling in from DC, representing Chemonics. Great. Hi, Glenn, calling from the Philippines here. It's past 8 in the evening. Yes, we have some presenters who can commiserate with that. Thank you for joining us, even at that late hour. And great, Satish from Nepal. Excellent. Nice to have you with us. So great spread so far. And like I said, we're going to get more started officially in about 2 minutes or so. For folks who are just logging in now and hadn't heard earlier, the 2 features we're going to use in our webinar today are located at the bottom of your screen. Sometimes you have to go down there and hover your cursor to get the bar to pop up. The first one is the chat. And so the chat, again, is a great place to share information with each other, to speak with your fellow colleagues in the webinar. All you've got to do is click on everyone. You can also private message someone if you would like. You can tell us if you like a statement. You can add in more information from your organization's perspective. So that's a great place to get some chatter going. If you do have a more specific question for one of our panelists today, as you hear their presentations, we would love to try to address it during our Q&A. And so also at the bottom, you'll see there's a Q&A function. That's a great place to submit your questions. We'll be organizing those and responding to as many as we can during the webinar. Ademola, great. Thanks for calling in from Nigeria. Excellent. Nice to have you with us. And thanks to folks who continue to log in. So hello to Ariana and Carolyn, Ciara, Danielle, Eric. So lovely to have you all with us, in Savannah. We are going to get started more officially in just 2 minutes or so as we get our webinar kicked off. If you haven't had a chance to yet, we encourage you to open up your chat and share with us where you're calling in from today. And that chat will be a great place to share information and talk with one another. We'll also be sharing information with you through there. If you have a question for any of our panelists today, we'll ask you to pop that into the Q&A. That's also at the bottom of your screen marked Q&A. And so that's a great place to submit your questions, which we'll organize as we get started. Excellent. All right. Great, so we are right at 8:30, and I see a whole bunch of folks just starting to log in, which is excellent. Maybe we'll give it just another minute, and then Sashi, I'll hand it over to you to get us started more officially. And again, welcome to folks who are logging in. You're welcome in the chat to put in where you're calling from, what organization you're here on behalf of today. Great to see that. And again, welcome to all the folks logging in now: Keith, Kevin, Natalie, Susan, Sana. Great to have you with us. I'll just give a final set of instructions as we get started with this climate finance webinar. And so welcome again today. We're really delighted to have you. We're going to officially kick off in just a minute. For today's webinar, we're going to use two features which are located at the bottom of your screen. And so the first one is the chat. This is a great place to share information. And if you open up the chat right now, you'll see that folks are putting in where they're calling in from and what some of the organizations are that they're representing today. This is a great place, again, to share information or links to give a thumbs up or a +1 if you agree with something one of our presenters has said or want to emphasize a particularly interesting point. If you have questions for our panelists, we're going to ask you to use the Q&A feature, also located on the bottom of your screen. You'll see that there's a place there to submit a question. We'll, of course, try to respond to as many questions today as possible, and the ones that we don't get to, we'll follow up on. All right. So with that, I'm delighted to hand it over to Sashi to get us more officially kicked off with today's webinar. If you've got any technology questions or issues throughout, please just chat to the hosts and panelists, and Sophie Schrader and I from Climatelinks will be happy to help you with your tech challenge. All right, so Sashi, let me hand it over to you.
Thanks so much, Meredith, and welcome everyone to our exciting discussion today on climate finance. This is the third in a series that we're holding to be able to share more information on USAID's ambitious new climate strategy, which starts in 2022 this year and goes up to 2030. My name is Sashi Jayatileke, and I'm a senior climate finance advisor with USAID. I've been working with USAID for over 10 years and working on development finance for 2 decades. We'll be covering today some exciting topics, and we've got really excellent experienced panelists sharing their thoughtful experiences on how they have been able to mobilize finance in their respective countries and programs. But I'll start with a little bit of an overview of our strategy. Go to the next slide. We'll be covering 6 main targets under the climate strategy today. Next slide, thank you. We have a range of topics, but really under our climate strategy, we know that people's lives are increasingly upended and cut short by drought, storms, fires, and floods that will only become more destructive until we act with urgency and ambition to address the planetary demands. Climate change is threatening our development progress and exacerbating global inequalities, and increasing water and food scarcity and the need for humanitarian assistance and displacement is critical. Our strategy includes 6 ambitious high-level targets that reflect how the whole of agency can work to increase our impact. In this sense, it's different from years past. We are looking at climate across every sector that we work in, and it's not business as usual looking at simply our environment portfolios. Today, we're focusing on the target that's really focused on mobilizing $150 billion in public and private finance for climate solutions by 2030. These targets were developed with our monitoring, evaluation, and learning staff from across the agency, and is based on our prior experience working in these sectors. While ambitious, we know that with a cross-agency approach, they are achievable. Next slide. The strategy does enable us to both confront the most urgent demands of the climate crisis and transform systems in a way that helps us to lock into feasible net zero climate resilient pathways. To do this, we're approaching it in 2 different strategic objectives. The first one looks at targeted direct action, and the second one looks at systems change. Today, we'll talk a little bit more deeply about ways that you might think to increase the flow of and equitable access to finance to support adaptation and mitigation. This is under Strategic Objective 1, 1.3, intermediate result. We'll discuss examples how we might achieve this using blended finance, which is in short using our development dollars to attract private dollars through risk mitigation and other means. Blended finance under our strategy is the use of development funds to mobilize private capital for climate results. And this could be improving climate resilient infrastructure, climate resilient agriculture, helping to create green jobs, and more. Under Strategic Objective 2, we'll be supporting a transition to a resilient net zero economy and financial systems. As we think about systems transformation, we have to think about how we can build economies that are enabled to work and achieve our net zero pathways. Examples of this work will be discussed in our next presentation as we think carefully about how to engage banks directly and have investors think about divesting from fossil fuels and investing in mitigation and adaptation solutions. Only through this dual approach of both targeted action and systems change do we think we can actually achieve pathways in the countries we work in to net zero. I'm really excited to announce our first speaker, who is staying up really late in her hometown of Bangkok, Thailand. She'll be speaking to us a little bit about programs that she's worked on in over 20 years of working in climate change and ecosystem management across Asia. Suphasuk Bird, as she's known in the agency, Pradubsuk, has worked with USAID in the Regional Development Mission for Asia in Bangkok since 2011 across a variety of programs and activities. She's currently our core of the Green Invest Asia project. I'm excited to turn it over to her and go from there. Thank you. Over to you, Bird.
Thank you, Sashi. Good morning, good evening, everyone. And my name is Suphasuk, and you may call me by my nickname Bird. And thanks for an opportunity to discuss results of the project with a focus on mobilizing climate finance for sustainable agricultural supply chains. Next slide, please. So my talk today will focus on the project approaches and example of business model that address USAID climate strategy priorities and target quoted here, which are mobilizing finance and transform key systems to reduce emissions and enhance climate resilience. And our target sector here is agriculture business in Southeast Asia. You may ask why it's critical to scale up agriculture sustainably. We are all facing a global dilemma of food security, land use, and climate change. The world needs to double food production and at the same time preserve more forests and reduce emissions. World leading companies commit to net zero emission but are struggling to mainstream sustainability approaches and working capital into their operational and supply chain. Next slide, please. So USAID Green Invest Asia was awarded in 2017 by using a Sustainable Landscape Fund for $21 million with goals to mobilize $200 million private finance to reduce 25 million metric ton carbon emissions. Our implementing partners is PAC and sub-IP is Mekong Strategic Partners. So together, they are a great team of finance and environment experts. So in the nutshell, as you can see in the slide, this is our strategy. Green Invest Asia connect mid-growth business ticket size from about 2 million to 20 million US dollar with like-minded investor to build green investment pipeline. And we target mid-growth business because they play a major part of the supply chains, but don't have sufficient asset or sometimes considered too risky for most investors. We focus on commodity linked to deforestation, such as rubber, coffee, coconut, and all you can see in the list. Basically, there are three ways we call private sector investment, which later we will show you example. First and foremost is single purchase transaction, which is one business model we do at a time. The second way is multiple transaction through partnership with a large multinational buyers, and we can help them de-risk business in their portfolio. Last but not least, the third way is support low carbon sustainable sourcing strategy. So in this case, multinational corporate are investors who put their working capital to distribute intervention into their suppliers. Next slide, please. So this diagram shows our partnership screening process, which is critical to ensure the right partners and target timely achieved. So from over 200 expressions of interest received, we screened to 59 MOU to provide technical assistance. And clearly 8 out of the 59 MOU got investment secures, so then turning into our target achieved. And as of now, we have mobilized 59 million US dollar, resulting in 53 million metric ton carbon emission reductions. Next slide, please. So next, we will show you example of business models and how our technical assistant can help de-risk the investment and advance purchase agreement. Next slide, please. So this one is green bond in agriculture. An example, our single transaction service made to Lionheart Coconut Farm in the south of Philippines. And as you can see, there are preparation steps required for launching the green bond, and we help the Lionheart Farm fasten the process by packing the environmental and social qualification for investor and the third-party verifications. So now the Lionheart Farm is raising 10 million US dollar through green bond that will, one, offer investor a return, and two, financing its coconut plantation and forest restorations. Next one, please. So this example is one of multiple transactions we have with Myrova, an asset management company, to develop voluntary carbon offset projects. So for this one, Green Invest Asia facilitate a 14 million US dollar investment of Myrova Land Degradation Neutrality Fund into Kinema agribusiness, so that Kinema can generate carbon offset from agroforestry cacao in Mindanao, so Philippines. And our investment readiness package in this case include capital matchmaking, financial modeling, and spatial analysis to identify forest regulation sites. So the success of this business model includes, of course, one, its sales of cacao. Number two is the futures of carbon offset. Third, financing from a commercial lender who commit to environmental and social safeguard. And of course, last but not least, the farmer alternative livelihood. Next slide, please. So let's take a look at our joint approach in the coffee sector to transform their operation and sourcing towards sustainable. So we are working with the world top 2 coffee roaster, Nestle and JDE Peet, and these two source half of the world green coffee, whereas Southeast Asia account for 1/4 of the global coffee trade. Through JDE Peet and their supplier, Green Invest Asia helped them establish an emission inventories of the coffee productions in Vietnam, such as cost-effective practice to reduce emissions, such as where to replace overused fertilizer with intercrop. And with Nestle in Indonesia, we are building on result of JDE from Vietnam and together determining emission factor for coffee that can be used for both companies, so that we can send market signals to their suppliers and farmers about criteria of low carbon productions as a priority for purchasing. Next slide, please. So this is lot example, the coconut charter. This is another example of the joint approach to improve sustainable supply chains. So this charter is the coconut industry first attempt to harmonize company requirements to address climate commitment while boosting farmer livelihood and supplying to meet the global demands. We start with facilitating roundtable meetings in 2019, and later we co-founded and launched the charters. And now the charter with 14 company members that control almost half of the global market are co-developing a consistent approach to deliver impact at scale and share best practice with others. What we found in common in the coffees and coconut sector is a common need for sustainability standard across companies. And USAID can take roles as non-biased facilitators of that pre-competitive collaboration to advance sustainable supply chains. Next slide, please. So after 5 years of Green Invest Asia implementation, we would like to share you some lesson learned and insight useful for our community of learning. Next one, please. So this is my last slide. This is lesson learned and insight. First and foremost, not all nature-based or climate solutions are market-driven. Mobilizing finance work well in a business with financial incentive clearly defined. Second one is technical requests could be anything, many times we sort out supported from short-term technical assistance. But what most important is the core team have to be able to analyze and identify what business and investor need to mobilize the investment and then be flexible to provide technical assistance. The third one is bear in mind that demand-driven market and timeline are sometimes difficult to estimate or control over. And these above 3 points common insight for all development sectors and donor support via either blend finance that you hear more from other speakers or being flexible to provide technical assistance in need is critical for businesses to grow from a startup to a stable and self-sufficient. And last 2 points will be specific on sustainable landscape sector. From all kind of technical assistance we have got so far, carbon footprint analysis is a common one, and that confirms usage value added on measurable impact. Because many sector target without strategy or sometimes they measure it without the baseline. And last but not least, the last point is, as you can see at the COP26, up to 3,000 companies commit to net zero emission by 2030. The current gap is only few companies measures and report indirect emissions occur in the value chain, which is actually these indirect emissions are like about 70% of the total. So working together to address the gap would be how we co-create pathway to lower carbon emission by changing business as usual. So that's all from me now. Thank you. Back to you, Sashi.
Thank you so much, Bird. There was so many rich examples in your presentation on how we can understand both pathways to systems change with our corporate partners that work in commodities like coffee, cocoa, and coconuts, but also specific actions that we can take now to help them on things like ESG reporting, third-party verification, and even things like investor outreach. I think it's really important to understand that when we talk about finance, it's not just about the actual finance. I think that's what often people think is needed, but it's a lot of this pathway to getting the transaction that you described that's critical. And without our ability to provide education of these new business models, to gather investors together along with corporate partners to talk about the potential for sustainability in their supply chains. It's that power of networking as well that really does matter. And so Green Invest Asia has been really a leader in helping us understand how we can do that, both as donors and also learning from our private sector partners. So please feel free to ask any questions that you might have of Bird. There was a lot in her presentation, but there's also a lot more available on Green Invest Asia on their website, as well as on Climatelinks. But now we'll turn to our colleagues joining us to talk a little bit more specifically about what is finance and how can we make it inclusive for climate. Our speaker today from Dalberg Advisors is Fabiola Salman. She is based in Mexico City and works extensively in the intersection of climate and finance in partnership with development agencies, NGOs, and financial institutions. Fabiola is working with TNC, the Nature Conservancy, to identify opportunities for financing the transition to regenerative food production. And she's also worked with USAID to identify the barriers and opportunities to finance sustainable landscapes through small producers in Mexico, which she'll be talking about. Stevie Smyth Valdez is the Executive Director of SVX Mexico, an impact investing and advisory firm based in Mexico City, where she's responsible for firm strategy and institutional relations. She's worked with entrepreneurs across the world for more than 10 years, thinking about venture philanthropy to catalyze markets and using a gender lens investment approach. With that, I'll pass it over to you, Fabiola.
Thank you very much, Sashi, and it's truly a pleasure to be here. As mentioned, I'm Fabiola Salman from Dalberg. We're a social impact advisory firm. And last year, we had the opportunity to partner with USAID to conduct a study that allows to understand how could blended finance be used to increase the speed and scale of climate finance. In that work, we identified mechanisms, case studies, lessons across every stage of the investment, and therefore I'm very happy to be here today to introduce the topic. I think the case for more capital toward climate is already clear, so we don't need to spend much time, but just to put things into perspective, it is estimated that the annual climate financing available is $1 trillion below what that is needed to meet the global climate goals of 1.5 to 2 degrees. That is from an estimate of the 1.6 trillion needed annually until 2050. And those are really big numbers, and it shows the importance of private sector, that the private sector role can and should play in closing those gaps. And in the private sector already plays an important role. There is an estimated investment every year of $300 billion, and that represents about 50% of climate finance available. However, there is a need for more diversity and more investment. The private sector mostly invests in mitigation activities because they are comparatively easier to monetize, easier to measure their outcomes, and have higher returns comparative to resilience or adaptation activities. And even within mitigation, the investment is mostly concentrated in energy and transportation sector, where again, we find a more clear business model and a lot more policy support to these outcomes. And this is where blended finance can come in. And I know this is a term that has gotten very popular and it's not always very clear of what it means. So happy to provide that. Blended finance, maybe just to start by saying what it's not. It's not an investment approach. It's not a new instrument. It's not a solution in itself. It's also very different from impact investment, which is also a term we hear a lot. How we define it is it's just a structuring approach that will combine donor and philanthropic funding and then private capital on the other side to increase the opportunity for private investors to generate positive development outcomes. And it does this by addressing two main barriers that private investors frequently face. On one side, there is a higher and sometimes real, sometimes perceived risk of certain investments. And also when we look at the risk-return equation, there are other investments that will be more favorable. And so through this, we allow private investors to participate in projects that they wouldn't have otherwise done it. And that is what makes it very exciting. And if we can move to the next page, just briefly to show that this is already happening. For this study, we use information from a platform called Convergence. It's a very interesting resource for those who want to take a look. They're a global blended finance platform focused on developing countries, and they do a lot to facilitate transactions, educate. And we were able to estimate about $31 billion for climate-focused investment that have been channeled through blended finance model. And then, as mentioned, they have been used mostly to pioneer or to scale up financing on new technologies in renewable energy, energy efficient, transportation, as well as some other fields. I think it's also important to note that USAID is already playing an important role, and this has been mostly concentrated in a few countries. So we found a lot of activity in India, Brazil, and Mexico, in which USAID already by alone represents about 16% of all commitment to development agencies through these channels. So this is definitely good news, but we all believe that there is more to be done, and that's hopefully why we are all here today. So in the next page, I want to briefly describe some of the mechanisms of how public sector actors and development agencies like USAID, but also others, can catalyze investment to increase the speed and scale of climate actions. And there is a range of support services, and this very much is aligned with what Sashi just mentioned of, it's not just about the financing, but the pathway to the transaction, and how can we kind of make that happen easier, more effectively, and facilitate those, especially given where many of you are sitting at the core of the development ecosystem. So I wanted to mention and describe a few of these. The first one is catalytic or concessional capital. And this sometimes feels like the most clear and the most direct, and in which USAID or another agency will provide capital that is willing to absorb the risk or accept lower or no return for a transaction, as long as the transaction has climate adaptation, resilient, or mitigation outcomes. So this enables a private sector actor to capture more return in the same transaction. There is also the opportunity to reduce the risk, which is done usually through guarantees or risk insurance, and just covers part of the risk in the event of losses, and that also permits to crowding capital actors that wouldn't otherwise have investment, because as I mentioned, the risk-reward equation wouldn't have compared favorable to their other opportunities. There is also the much needed area of support of identifying and assessing investment opportunities, in which we can help investors, banks, and other sources of financing understand what are the market conditions, how can we identify potential opportunities for investment, and how to compare them to others. Then there's also the very much needed activity of matching capital suppliers with business and projects, and supporting that connection among actors that might be in the same ecosystem but might not have the experience of working with each other. Another area is offsetting project preparation costs. These transactions are still sometimes complex to structure, sometimes it takes time, and we need to, as we have more examples, we'll be learning more about what are the practices that work. But we find that the time that it takes to get all the actors in place to prepare a project, to understand the structure, sometimes prevents private sector actors from participating in the activities. And at the same time, being involved in the project preparation allows us to ensure that the social and economic benefits are really embedded in the design. And finally, through technical assistance, which also might be more familiar, is just helping improve the commercial viability of climate projects, either in the pre-investment or post-investment stage. So I think the main message here is that there are many ways in which an organization like USAID and others can play a role in improving or driving and scaling more blended finance toward climate activity. And if we move to the next page, one of my last points I want to make is that why we see a lot of value is that it creates additionality. You know, there is a lot of focus and a lot of importance in making sure that we do not use resources to activities that will have happened otherwise without the participation of a donor or an agency. And we find that there's two main ways in which blended finance drives additionality. The first one, from a financing perspective, is just when it allows finance to flow to an entity that wouldn't have otherwise gotten it without the participation, or wouldn't have gotten it in the same terms, to the same amount, or for the same development objective. So this is very clear. And one example, and I know this is something that is looked in many USAID projects, is what is the ratio of how much am I mobilizing for every dollar that we're putting in. And the example we had, BFC was able to mobilize $30 for every dollar invested for the African Clean Energy Finance Initiative. And it's a really exciting example of the potential of mobilizing additional resources toward climate. The other is what we're calling ecosystem additionality. And here we're talking about system level impact that will not have occurred simply from a financial transaction without the involvement or partnership of development assistance organizations. So here we're talking about policy changes, regulatory, sector and business changes in the activity from sectors and businesses, demonstration effects. And one of examples that we think is also very powerful is the Bio-Red Plus, where about 30 laws, policies, and regulations were kind of created and aligned along with the financial investments to improve the overall impact of a specific project. So there is a lot of why we are all very excited across the sector for blended finance. It can not only mobilize more funding, but also can be doing in a better way and increase the impact. But I think the best, and without going more into the lessons that we capture and the other case studies, I think what is best is just hear from people that are doing it every day. And one of the examples that was mentioned of blended finance being applied in Mexico. And just to provide a little bit of context, in 2020, we at Dalberg led a study that we identified the barriers that were limiting financing to sustainable landscapes in the south of Mexico. This was an input to a co-creation and convening activity that was launched also in 2020, right when the pandemic was started. But that didn't prevent a group of local actors that were NGOs, implementing agencies, research organizations, investment facilitators such as SBX, and others to get together, share ideas, present concepts, refine them together, refine the understanding of what were the barriers. And from that emerged a very exciting project that is currently being implemented by CI, SBX, and other actors. And with that, I'm very happy to pass it on to Stevie. I've heard about this project many times, and I think it will be great to hear more details about it.
Thank you, Fabiola, and many thanks to that introduction to blended finance. And I wanted to thank also the USAID and the Climatelinks team. They've been fantastic in preparation. If we can go back to the previous slide, and I want to talk in my brief time that I have with you all today, I have two goals. First, to convince you to move as much of the climate financing activities that you're doing and the dollars that you're spending on climate financing to the stewards of the land as much as possible, given the restraints on the financing that you all have or are implementing. And the second goal I have today is to provide specific examples on how donors can implement the activities that Fabiola just mentioned, and give you very specific context on how we're doing this in Mexico. And then, of course, can answer questions on how an advisory firm like us works with private investors, NGOs, and USAID in order to make this happen. So just to give a bit of context as to why this is so important, Fabiola talked a bit about the need for additional climate financing. And when we think about climate financing, we think about scale and we think about big scale. And I think that's absolutely important given the gravity of the situation we find ourselves in today. With that said, 1/3 of our forests, which are our carbon sinks, still remain on indigenous land. Yet our communities are receiving globally about 1%, 1 to 5% of financing for environmental protection or for climate change, either mitigation or adaptation. This is even more acute in a country like Mexico, where actually more than 50% of our land is owned by indigenous peoples. Most of this land is owned in a communal fashion. But the great thing about this, and we love to talk about assets and potential and not just challenges when we look at ways that we can move forward, and SVX Mexico in particular, is that we're working in Mexico with decades of international development agencies, as well as the national and local Mexican government entities, creating cooperatives and strengthening cooperatives in the country. So we have an agrarian society. There's a lot of activity in agriculture, forestry, and land use sector, or FOLU sector. We have cooperatives that have been working for decades on governance activities. And we have a wide variety of actors, particularly in the financial ecosystem. But we need to figure out a way to match the mismatching in funding, as in we have large transactions that aren't necessarily structured to get into these communities, or we're not getting enough of that funding going directly into the communities in order to meet our climate targets. If we can go to the next slide. And going back to Fabiola's study, so Dalberg did a fantastic study on some of the barriers to financing in particular during 2019, 2020, that launched into a BAA process in 2020 that we did 100% online, given the nature of the pandemic. And some of the barriers that were discussed in that Dalberg study are some of the barriers that we're now directly addressing as a consortium of actors in Mexico. So the barriers that we mentioned here are obviously lack of finance, and everyone says there's a lack of finance for funding, but let me get a little more nuanced here. The lack of finance for producer organizations under better conditions for mitigation and adaptation activities is key. Debt for agriculture production exists in Mexico and exists on a large scale. However, if you need a specific type of financing to renew your coffee plants, that might take years to provide a return on that capital. That type of financing is not necessarily provided by the local debt agents or the local debt providers. And there's no one that's necessarily coordinating the donor or the subsidy dollars with the investment dollars in a cohesive way. The other thing that happens quite a lot, SVX Mexico has been working in the market for 6 years now, and we often find investors, particularly international investors, that have a mandate to invest in a FOLU or sector in Mexico, and they have investment theses that just can't find projects in Mexico because the projects aren't ready according to those theses that the investors are looking at. Furthermore, access to market is absolutely crucial. And I think we saw this in the Green Invest Asia presentation as well, and some of the activities are actually quite similar, and we can talk about some similarities and differences in the Q&A. But the agricultural producers in a cooperative need access to markets in order to really receive and the full fruits of their labor. In Mexico, we have a particular challenge with intermediaries that are taking the good part of the value out of the project. And cooperatives have a huge potential to actually receive much more of that margin, providing it much more of that money back to producers and disincentivizing the growing of the agricultural frontier. And so there's other challenges like lack of information sharing and risk sharing by all in the value chain. And there's also a study that myself and my partner Laura Ortiz, my business partner, and others came together to publish in 2021 around some of these community aspects of financing. So if we can go to the next slide and talk a little bit about the solution. And I'm going to put a website in the chat for your reference. So the solution at this point is called Sustainable Landscape Ventures. It is a 5-year USAID funded program in Mexico. And one of the key components is what we're calling right now the blended finance engine. The blended finance engine is a coordination mechanism for capital and for markets. It is essentially a governing body that receives projects, as in cooperatives, and sometimes for-profit businesses that are looking for either buyers for markets or for products and services that are sustainably or regeneratively produced, or they're looking for financing. The projects arrive to us and we do what's called a project curation process, where we understand what the financing needs or what the marketing or the market or product needs are for the company. And then we link them to the right donors, investors, or buyers in that sense. The challenge is many of these companies need a mosaic of financing. And so that's where the blended financing comes in. There are members of this blended finance engine that are both donors and they're debt investors. And very soon, and we'll talk about this, some are looking to be equity investors. The first cooperative that went through this process is a cooperative with about 124 families in the state of Oaxaca. They came to us asking for about $1.5 million US. Through the project curation process, we determined that maybe they needed a little bit less financing, but also we determined that they don't just need debt for working capital and capital expenditures, meaning to finance their harvest or to finance new machinery. They actually needed some donor funding for improving technical assistance in terms of the administration of the company. So the blended finance engine was able to call on different donors and different types of investors to provide a mosaic of financing to this one cooperative or this one company, just to provide an example. And with the very limited time next, we'll go to the next slide and talk a little bit about some of the innovations. With that said, we know that there are different ways that we need to get money to cooperatives. Again, we're going from this theme of large amounts of climate financing and how to get this down to the stewards of our land. And one of the things that we're currently working on, so this is a work in progress. This is not 100% signed, sealed, and delivered, but we're working on a way to find more innovative ways to transition producers. So I think the transition finance is one of the things that's the most difficult and where blended finance can have the most effect. We see a lack of equity financing available in the Mexican market, in particular in agribusiness or forestry and similar companies. And a lot of equity investors are not willing to take on that risk. So we're looking at, and potential with this program with Sustainable Landscape Ventures to support some of this, is structuring a new equity fund called Regenera Ventures. This will be a transition financing, and this is a 10-year fund that allows the first years of investment to really make changes to practices without maybe receiving a lot of return on that investment in the first years, and then a lot of return on that investment in later years of this, of the investment term, again, going towards 10 years. And how this is blended. We're looking at grant funding for the startup and structuring costs, which are quite costly, and for a risky fund of this nature is really helpful in order for an entity like SVX Mexico to invest the time and legal fees and whatnot in order to get this going. And we're also working with a local development bank or a couple of development banks on a concessional, what we call tranche of financing. We can get into some of that in the question and answers. But the idea is to reach these goals. of steward-owned companies, finding ways to invest more equity into steward-owned companies in such a way that they maintain ownership at the end of the investment term. So those of you who might know a little bit more about the investment and the technical aspects of it, if you have questions, happy to answer. But essentially, after the 10 years, Red Canada Ventures would exit the investment from the companies and leave it in the hands of the same stewards of the land who are already involved. I'll pause there, but because I think I'm a little bit over time, and send this back to Sashi, I believe.
Thank you so much, Stevie. There was actually so much in that presentation I feel like we could dig into. And so we are doing great on time. So I hope we can come back to a couple of your slides and dig a little deeper on, especially the convening of the local communities and the discussions you had. I think it's also really interesting to hear the theme of both how you were able to get to your actual activities by talking to the local communities. It's similar to the Green Invest Asia approach of, again, bringing partners together to communicate, what are their supply chains. In the Green Invest model, they were getting, the companies together to communicate about what their challenges are. But in your case, you brought the local communities to the table to ask them what they needed. Both, I think, highlight what is really an underutilized tool in our toolbox, which is our convening power, our ability to bring people to the table. And I think that is at the heart of a lot of what we're trying to do under the strategy, and even in the broadly in the agency, and how we look at locally led development. So thank you for those remarks. And again, I wanted to make sure everyone knows you can ask questions in the Q&A, or you can wait till we have 30 minutes at the end for a rich discussion. So feel free to drop those in. We'll try to answer some of them as we're speaking. Our next speaker is Dr. Serena Guarnaschelli. She's an expert in blended finance, impact investing, and inclusive business model. She brings 20 years of impact finance experience with McKinsey and Dalberg advisors, advising corporates, foundations, and investors on how to transform their portfolios through sustainable and impact-oriented strategies. She also launched and designed the Convergent platform, which we referred to earlier in the presentation in terms of some of the facts around blended finance. This platform is often used by donors and NGOs and the investment world to understand some of the data that's underlying what's working in blended finance, but they also have windows for financing. She was their first director of the investment network during its launch. She has experience structuring and innovative financing mechanisms, such as the world's first humanitarian impact bond with the International Committee of the Red Cross. With that, I will pass it over to Serena for the last presentation.
Yeah, thank you, Sashi, and thank you to all the panelists before me. They did part of what was going to be my job in terms of talking a bit about blended finance, so I'll skip that. I'll refer to some of the things that I've been talking about, but what I was hoping to bring was a little bit of the lens of the structuring of financial products and some of the ingredients that have been mentioned before, and also looking at through the lens of investors. And maybe as a piece of context, as Sashi introduced me, our firm, I represent the advisory side of our firm that is really focused on structuring financial products, but we also have an asset management side where we try to also bring some of those insights that we have from raising and managing money into the way we design our products so that they're ready for investors, for a wide variety of investors. And I will not talk about the gaps and the needs because so many before me have. I think I wanted to twist that question around as we see at COIS, as well as some of our investors see some of these gaps as investment opportunities. And I wanted to talk a little bit about where the mismatches might be and how we can change these perspectives using blended finance and make some of the pipeline more attractive to a variety of investors. So the first perspective I want to say, lessons learned from our work in structuring initiatives, very similar to Green Invest Asia or to what Stevie talked about, is that you have to look at the space of climate finance, and specifically we're working sustainable land use, so sustainable agriculture, sustainable forestry management, as well as some integrated products. You have to look at this for what it is. By far, with a few exceptions, and I'm going to talk about those in terms of some more established asset classes, This can be seen and can be perceived more as an early stage VC-like space. So not ready yet for large institutional investors, but definitely a good place for impact-oriented investors and some are also banks and investors looking to diversify their portfolio. But I would like to turn that around, because while I think that is true, and I'm going to talk about a little bit about the stages of development of different asset classes, I do think that it's one of those stories where the risk perceived is certainly higher than the real risk. And as some of the people spoke before, I think often it is, it comes down to new geographies. We're talking about emerging markets where there's a perspective about the increased level of risk, and particularly when you work in sustainable land use, certainly higher risk perceived in land rights and the ability to actually finance some of the land underlying some of these assets. And also some of the sectors. So as previously spoken about in climate finance, where most of the money is going is in mitigation, low carbon transportation, and renewable energy take the lion's share. And some of these other assets, like even sustainable agriculture, sustainable land use, are considered as nascent sectors and not really yet part of most of institutional investors' capital allocation strategies. So they're still perceived as riskier. The second challenge underpinning this, these gaps and capital needs is the fact that in order to make a lot of the pipeline investable, it needs to be aggregated. And then if you're talking about institutional investors, add another layer of securitization. Now, this takes time and cost. And I think this also speaks to some of the roles and also some of the facilities presented before have been designed, where a fair share of money and time needs to go into creating, aggregating the pipeline, supporting the pipeline in terms of technical assistance. And this tends to be relies on more concessional financing, if not grants. And the third challenge, and again, we like to see it as an opportunity, is that sometimes, particularly for some of the natural assets that need to be funded, whether it's for example, if you move from sustainable forestry, which is when you take a forest and you extract wood in a sustainable way, to actually reforest or afforestation. Now, when you're talking about actually generating positive natural benefit, it takes longer, and often the economics benefit and the environmental benefits start aligning after 12 to 15 years. So it is definitely a space for patient capital. And as we know, this is not a world. A lot of investors look at risk-adjusted returns for facilities and funds where they can take their money in and out, sometimes with very high expectations on liquidity. But usually as you reach the 3 to 5 years, it does become harder to raise money that has a longer tenor beyond that. And yet we see that that is where actually a lot of the environmental benefits and the associated social benefits can actually be monetized. So with that in mind, I wanted to do a short deep dive into sustainable land use on the next slide, and taking a bit of a step back. And this is really a space where some of the facilities that have been presented really fit in. But I wanted to characterize a little bit about now the role that blended finance, so that strategic use of philanthropic and public capital can play across a couple of asset classes in SLU. So if we can move to the next slide. Thank you. So I wanted to take just a couple of examples. And again, you will see that some of these are recurrent themes that have been brought up earlier. So one I talked about, sustainable forestry production. Now, this is interesting because within SLU, which is currently underfunded, and so more investment opportunities than current capital flows, but certainly sustainable forest production, particularly through timber investment and management companies, is quite an established asset class, raising quite a few billions, both established in the US, in Australia, and in New Zealand, so in developed markets. But there are now examples of these funds being replicated in emerging markets. And what's interesting is that this tends to be a relatively long tenor. So these are real estate models where you acquire the land. Usually you are able to decrease the cost. For example, in the US, you can sell conservation easements, which means that you give up the right to further develop the land, and this reduces your cost. But there are also foundations that, for example, invest on a mission-related basis into these funds and provide them with low-cost debt. And this is what we're seeing in emerging markets. So there's a higher perceived risk. So there's certainly a role, for example, for guarantees to play. But there's also a role for, you call it impact investors, philanthropies, and so on, to actually participate in some of these structures, accept a lower interest rate, and allow the fund managers to expand and raise capital, for example, tapping into institutional investors, without necessarily increasing the level of risk. And in some cases, one interesting features for these funds has been that the philanthropic investors that are investing with a lower cost of capital and accepting a lower interest rate might sometimes even give up some of the interest rate if the project achieves certain impact measures. And so then the fund manager is able to reinvest some of these proceeds, which are the savings on the interest rate, into the projects themselves for deeper impact. The second asset class I wanted to talk about is around sustainable agriculture production. And I think this is also something that Stevie and also Bert talked about, where we see capital flows flowing primarily in large primary producers and in value-added processing activities. This is where currently commercial or sub-commercial activities happen, with some role for blended finance, but quite limited. Where we see the opportunity for blended structures is in the next wave, so to speak. So as you move below plantations, as you go into smaller commodities that require more aggregations like cocoa and coffee, or as you move into different markets where it requires more effort into aggregating the pipeline. And so one structure that I wanted to give a shout out to is the Tropical Landscape Fund Facility, which is set up to provide long-term, so really that patient capital, affordable, so at an appropriate cost of capital that is in line with the farmers' underlying capital needs. And what TLFF has been successful, one, it's a series of partnerships. As Bert also said, it's all about the networks. So they have partnerships with UN agencies, with UNEP and ICRAF, to originate pipeline. And they have a partnership with a bank, BNP Paribas, to offer pre-financing that they then deploy to the farmers, and sometimes with grades of grants and technical assistance from donors like USAID and others, to prepare the projects. And then when the projects start producing cash flow, they aggregate and securitize this cash flow. And again, USAID has played a role in the first facility by providing a guarantee and de-risking it. And then they sell these notes in the market. And this is where it's exciting, because as they sell the notes, there are junior notes and senior notes. And so they have a range of investors, from development finance institutions to institutional investors. And as they sell their notes, they can replenish the facility and move on to the next project. And so they've been successful with the first fund of the facility, which was focused on rubber. And it had another key component is that they have corporate off-takers, in this case, Michelin, that also helps de-risk the model. And then they can move on to the next. And right now they have a pipeline that I think is valued at around over 350 million. But as they move to other commodities like cocoa and coffee, the mix and the blend of grants needed up front, for example, to prepare the project, but also to offer livelihoods to the farmers before they become productive, might increase. And so it requires a bit more work and a longer time to market. And I'll conclude with one last project, which is much more about innovation. And I'll just say a few words on the next slide, which is a project which is a much earlier stage. But I think what we're trying to do is more, rather than scaling, it's more about innovating, which again, it's a partnership with USAID, providing catalytic funding for the design of the facility. And it's a partnership with industry, and it's focused on bamboo production. And I wanted to offer it as an example where I think this is for us the holy grail, because we have sustainable bamboo production where we can sequester actually greenhouse gas emissions, as well as preserve water. We also have a gender inclusive lens where the producer, the farmers and the traders are women. And livelihood upliftment for them and their households, including improved livelihoods over a number of years. So this is a 5-year product, 10 million. And the idea is that with IKEA as an off-taker, to be able to then look at, similarly to what I discussed for TLFF, to provide grants to put together these cooperatives, give them access to markets so that, as some of the speakers previously said, the value added remains with the farmers and the traders. And then draw investors in when the underlying bamboo farms and trading becomes productive, so in year 4 and 5, and moving towards an impact loan structure where actually the interest rate will be linked to both the social and the environmental impact that it's achieved. And with that, back to Sashi.
Thank you, Serena. That was an amazing presentation as well, and so much information that I feel like we would like to dissect in a longer period of time if we had. Just to go back to your last slide, I think, you know, it's interesting to see the intricacy of this model. And when someone looks at it immediately, if you come from an environment background or you come from a background as a climate scientist or working with farmers, it can be intimidating. And so one thing I like to, you know, share with my USAID colleagues as well as our partners is that you don't have to be a finance expert to be able to make something like this happen. That's why we have partners like Serena, Stevie, Fabiola, and Bird presenting today, because there are experts that can come in with this knowledge of how we both achieve development impact or environment benefits while trying to also mobilize private finance. I think what's really critical is that people don't have to become finance experts to work in this. You just have to know who to ask to bring to the table. And the approach here, again, that's important to highlight is that it started off with an APS announcement. And sometimes you do have to make that larger procurement in order to solicit the ideas from the private sector. That said, you know, Serena, you have experience in blended finance, you're working with COIS, you've worked with Convergence, so you knew to apply. So I think a question just, and I know we have a lot of questions in the chat box already, but a question to you is, you know, how would one go about being able to just start a conversation if they're on the implementing partner side and they don't have access to, you know, a COIS or a Dalberg or a Convergence? Are there ways and places they can go to maybe to be able to connect with firms like yourself?
Yeah, that's a great question. And first, I wanted to respond to your comment. It does look complex, but I think success in these initiatives do require multiple hands and multiple partners. However, when we go and fundraise, whether it's to a donor or investors, you need to keep it simple. So a lot of this is stripped. I just wanted to show you sort of like the belly of the beast, because where all this happens. But ultimately, you can look at it through the lens of a donor and what they care about and just show them what's in it for them, where they to fund with a grant or an outcome fund, and similarly to investors. So to them, it's just a straight loan with some features. And it really depends on who you're talking to. In terms of how to connect to firms or how to get support like this, I do think that in the space right now, both through the facilities like Convergence or networks like GIN or VPN, or even USAID, right, in terms of the windows that you provide in terms of research, there are a lot of case studies where you can take inspiration. But then, as you said, Sashi, the devil's in the details. So my advice would be to start looking for what might seem to be an inspiring example that you think would be applicable in your setup. And then start conversations in your networks with people. Sometimes often start working with some of the impact investors in the space to have a direction about whether that product would be of interest to them, how it might fit in their portfolio. And then obviously partnering with companies like ours. We do offer a lot of this, for example, with industry has been a joint venture where we have assisted them pro bono first in terms of how to think about scaling their model. And then it became kind of like a convergence of interest with USAID wanted to fund something like this and then structuring a product. So I would not necessarily invest in something like this until you're sure that there's an interest from either an outcome fund or an investor to invest in it, and then look for partners to help you actually put it together.
Thank you so much, Serena. Maybe I'll turn it to a couple of the questions that have come up already in the chat box. Stevie, you had a couple of questions regarding how you were able to design an impact fund that was weighted on outcome returns versus financial returns. Where do the financial returns come from if investing in equity in low profit margin ag cooperatives? And why would a company do this given the upfront cost and low returns?
Perfect. These are really good questions, and it's actually very helpful. So we've structured the idea of the fund, we have the model, we have some pipeline, which is an important part of how Sustainable Landscape Ventures is providing value to the fund. There are a lot of other questions that are yet to be unanswered. So all of these questions help us define even better the fund. I answered some of this in the chat. So the fund is structured as a $20 million US closed fund. That $20 million comes from or private investors or development financial institutions, but as an investment, meaning we have to return that capital with a return. It's much more in that middle area of the road that Serena mentioned on her slide deck of where we're thinking about where the returns can be provided. But actually, our investment thesis is embedded into the returns piece in the sense that everyone thinks of ag as low margin. It is absolutely low margin. The companies and the cooperatives we've been talking to and some of the financial models that we've been running through with the cooperatives we've been working at as part of Sustainable Landscape Ventures show very slim margins that may not even allow them to repay debt, much less something like an equity investment. But the thesis is such that we are investing in the transition to regenerative agriculture. In as much as a company is willing and able to take this on, will reduce costs of inputs and create higher margin projects. So we are investing in creating higher margins for the companies. And where possible, and this is not 100% possible in all of our pipeline, but where possible, our companies will be monetizing carbon. And so that's where the outcome financing part comes in, and that's what helps mitigate some of the risks of the transition finance as associated with what we're doing. But that's going to be, again, blending the different types of capital, including the carbon finance, the investment finance, increasing the margins in order to make this possible. Also, there's a concessionary tranche on this funding. So for those that are more advanced in blended finance, we're looking at this right now in about $3.5 to $7 million of the $20 million fund will have what is called a return cap, meaning the concessional investors isn't necessarily first loss or in that sense of taking more risk, but they're capping their return because they're a development financer. And that leaves more return for other investors in the fund. And so that way we're actually incentivizing new actors to take risks on equity investments in the follow sector.
Thanks, Stevie. That cap return, was that something that was designed into the blended finance engine? And so it was a part of the original design, or was that separate?
So that's designed into the fund. We see the fund as being embedded into the blended finance engine. Again, this is all in process, so none of the T's are crossed and the I's are dotted. It's all in process. And I guess that's actually one of the lessons that has been learned. In general, I worked a little bit in blended finance before coming to SVX Mexico, but donor financing tends to take longer than investor financing. So this capped return is actually an idea that comes from the local Mexican development institution that wants to be an anchor investor in this fund. And they said, hey, we want this impact so much. There's gender aspects to what we're doing. There's climate adaptation, mitigation, and investing in local communities that we're willing to cap our return in order to make this type of deep impact happening. Again, what we're waiting on at this point is making sure we get the donor part of the blending so that the structuring could happen, and then we can bring on the anchor investors. But that's the type of stakeholder engagement that it takes to be able to work with a development bank, with a private investor, with an NGO, and with the cooperatives and the communities to make transactions like the fund happen. The blended finance engine, the most important takeaway from this is that we're providing a mosaic of different financing. There's debt, there is donor financing, there's debt from international investors, as well as we're working to actually bring more local investors on board with local denominated currency, which is a big challenge in what we've seen in Mexico with the changes in the peso, et cetera. So that's, I think, what's important about the blended finance engine is that it can bring in actors like the fund, Regenera Ventures, but it can also work with impact-oriented actors like Conservation International Ventures is an important key stakeholder. Our first transaction we closed with Beneficial Returns, which is a US-based impact investor. So there are different ways that we can do that.
That's great. And there is a follow-up question I see in the chat box from Daniel. Do the investors capture all the returns through carbon payments into perpetuity if the companies succeed and or continue operations?
The answer to that at this point is no. So an investor will invest in the fund. It's a 10-year fund. As the companies make certain payments to us a few years out after what we call a preferred dividend to us, a few years out, assuming that the transition and the carbon financing works. After the investment period, we sell back the shares to the company, and then we leave. Regenera Venture leaves and leaves all of that in the hands of the company. That's assuming that the carbon financing comes from us. We have talked to other co-investors in Mexico in carbon. Some are interested in long-term carbon, but the investors in the fund would not receive carbon in perpetuity. And we don't necessarily believe in that. I have personally seen a lot of harm done by not giving carbon rights and as much of the carbon dollars to the community as humanly possible, because then it sort of mitigates all the potential for carbon. If we're not monetizing the landscapes and the ecosystem services that are provided and giving that to the people who are the stewards of the landscapes, then we're not doing our jobs, right?
Thank you. That's really excellent. Maybe I'll move to the next question, and this I will pose to Fabiola. This comes from Manuel Bueno. How financially sustainable will these blended finance mechanisms be without grants? How do we assess the potential long-term financial sustainability of these mechanisms without grants? And how do we design pathways to eventually reduce grant funding?
Thank you, Sashi, and thank you, Manuel. That's definitely a great question. I think at the core, when we're talking about blended finance, we need both components, right? We need the concessional development assistance, donor, philanthropic capital. But I think a little bit of you answered the question in terms of how do we set up this as a pathway, right? How do we ensure that we are preparing the communities and the farmers? Stevie was mentioning, if we assume that we can support them to the transition to regenerative, to diversified income, there is enough evidence at the moment that this can lead to higher margins. And at that point, they will be able to access more traditional, less concessional ways of financing. And I think we have seen that same in Mexico, where once they are supported through the process of becoming organic producers to be tied up to better, more fair value chains, then they are able to kind of sustain and continue the impact and continue the practices without the need for blended or donor finance. I think at this point, we're very much at the point where we see the urgency to expand finance and where we think that it's a great use of development assistance resources to create that switch that will generate more evidence, more learning, and so on. We hope that eventually, as investment decisions account for environmental risk and other changes in the ecosystem start happening, we will be able to make these investments more attractive without the donor component. But I think at this point, facilitating the transition, development expertise, setting up what is needed for the communities to start capturing other diversified sources of income does need that. We just need to make sure that in the long term or medium term, we can enable that sustainability. And I think we have seen cases where that is definitely the case, and producer organizations are able to then access financing that is not concessional, and then you can move on to the next producer.
Yeah, and I would say, you're speaking about a market that's extremely new in terms of business models, right? Cooperatives. But if you look at the renewable energy sector and what we've learned from that, there is a pathway eventually where grants are not needed and concessional financing isn't needed. And I think what we're trying to learn from is, where are there examples in other sectors that we can bring to sustainable landscapes as well? So I think while today we've been talking a lot about sustainable landscapes and natural climate solutions, which does require a little bit more of a subsidy, we have lots of examples in both our work and partners where our grants were eventually eliminated. And now when partners come to us for renewable energy funds, we have a higher bar for providing USAID grants or subsidies because we know these business models have been proven. That said, we know there are markets where the access is limited. And so in that case, there could be a purpose for providing a grant in terms of modernization of a grid or in terms of building out other types of mitigation like sustainable transportation. That said, yeah, I think we're still in a learning stage with what you all are doing. And that's why it's important, I think, that sometimes you do need a little bit of a sweetener. But again, the bar will be raised as we learn more in other markets. And I also would say it's interesting that, you know, you're both in Mexico. I think the market in Mexico is more sophisticated, where you had an investor come to you and say, we're willing to cap our returns. I don't think you would find that in all places. And so we have to be cognizant that, you know, every market we work in has unique conditions, and we have to take that in terms of how we then decide where our donor dollars go. Maybe I will open it up and ask a couple of, you know, broader questions that have come up from the audience. One relates to credit scoring and how we take this into account to consider sustainability. Another relates to how, if you've seen any programs working with women or youth, since we know that they have a harder time in terms of accessing finance. And then the third question, which I might ask Bird to speak on any types of work you've seen requesting combining nutrition and climate or WASH and climate.
Who should go first?
Since you're off mute, Bird, you can go first.
Oops. Okay, so I answered the last one maybe, and I see a lot of opportunity aligned when you think about the climate smart agriculture, that in the past people focus on adaptation and food securities, but when we try to put low emission practice in and move it to commercial scale, and in that case we can add mitigation value in climate smart agriculture. And no matter term you call it, food nutrient, food security, climate resilient, and I feel like we could be more creative on climate resilient. And one thing wonderful about sustainable landscape, even though it's variety of landscape ecosystem that you will take time to put it to work, but once it works, it offers you multiple benefits in addition to emission reductions. And yeah, and I think that's why it's value added. And I think we got a lot of questions from people on the climate adaptation fund, which I believe sustainable landscape effort can address all of that. Thanks.
Thanks, Bert. Maybe I'll ask either Stevie or Serena to speak on the questions related to women, youth, and or farmers.
Yeah, and maybe touching also on the other question as well. So as I said, every funder comes in this place with a slightly different lens. I think there's certainly more funding coming in with the climate lens than there is than the livelihood. But as I said, I think these are two sides of the same coin in terms of as you produce some of these crops more sustainably, guess what? And Stevie, you spoke to this, and it's our experience as well. As you move to regenerative agriculture, it's a win-win-win, because regenerative agriculture do generate savings from the first year. So a lot of what we see in terms of risk perceived or credit score, in fact, it's enhanced because it does lower the risk from an economic and environmental perspective. And it's all about how the lender sees this. So this is why, I mean, it's more the lens that banks and MFIs take on their own clients rather than what we see as the real, because often this does decrease the risk. And just to say that even though there is this a bit of a debate in our experience, a lot of what we do is gender inclusive. Most farmers in emerging markets are women. A lot of them are younger women. And so it's not always a youth inclusive, but if, for example, when we think about our projects in India, and we have a say on how we put together the cooperatives, we always apply a gender inclusive and a youth inclusive lens. And it's interesting because in other markets, like in France, we do all this work, by the way, in Europe. And so it's always interesting to see what's similar and what's different. We do see something similar, actually, because I think there's a lot of like old generation farmers that are very risk averse. They don't want to change practice, but they're also not necessarily interested in changing things, but they're also looking at the next generation. And these are often, you know, young people that they might be struggling with, you know, other types of careers and so on, and have a renewed interest. And these millennials, as I say, they do want to actually farm in a different way. So we do see an intersection already, particularly when it comes to agriculture, with both the gender and the youth. Now, when you talk about other topics, for me, a lot of agriculture, I don't know what the question was related to WASH, but there's a lot of, you know, for example, from a water perspective or from a sanitation, if you look at livelihoods and you look at how does impact communities, but this probably happens in smaller, more innovative projects, and nutrition as well. Because as I said, and as you said, Sashi, as soon as you start looking about a couple of outcomes, you know, livelihoods and environmental outcomes, it looks quite complex. So you also don't want to come, it does come a bit as a trade-off with initial scale, at least. But there is a lot of innovation that I think is going on in terms of trying to link perhaps how the funding is used, whether it improves nutritional outcomes, but this would be probably more in pilots that are trying to test a new approach. At scale, I think it's larger. And I think, again, if you want to keep things simple and investable, scrap everything, there could be quite a thoughtful design in terms of the structuring of the technical assistance and what it provides in terms of community development, inclusion, and so on. But ultimately, when you go and raise funds for anything that it's above 10 million, you need to keep things fairly simple and straightforward. So you have to tell a very compelling, straight story about climate and economics, or climate and livelihoods at best.
Yeah, it is very complex, but I do agree that you start from point A, and then by working in point A, maybe in 3 years, you get to point B with nutrition outcomes. That said, we are trying really hard with our climate strategy to engage all our colleagues across all development sectors in global health, in WASH, in agriculture, not to see this as a climate outcome as much as a way to embed climate-friendly pathways in their work. And so for those of you who have colleagues that work in other sectors, I would say it's the point of the strategy is to engage in discussions, and the design doesn't have to have all these development outcomes initially, but we do want to track and understand opportunities for combining and getting to the co-benefits, which I think we agree is possible. It's just not always tenable when you're thinking about in the very beginning how to get, for example, in the case that we're discussing here, you know, farmers access to financing for cooperatives that have climate smart agriculture. I did have another question for you, Serena, while I have you. In terms of, you know, the larger question of blended finance, and perhaps when you were back at Convergence setting the platform up, you know, why do you think it's important for a donor to provide financial support sometimes to an investor instead of directly to the smallholder farmer or the partner?
I love this question. It's so controversial. And by the way, even in my more recent work with, for example, the ICRC, where some of the donor money is used to pay the interest rate for Munich Re if the project is successful, has become a little bit like one of this eye-opening in terms of how risky was initially perceived by the service providers and by the donors in terms of their use of their funds. So let me preface that there is definitely a use. Grants is the most valued, scarce, and precious resource because it's super flexible, right? And there is a good role for grants to play in certain areas, which is, for example, direct technical assistance, but also in sectors like humanitarian assistance, where it's by far going to be grants are needed for this type of things. Having said that, and as we reflected on shrinking budgets, competing priorities, COVID, Ukraine, and who knows what else, there is a pressure on, if the money is limited, about how do we create, and it was spoken before, sustainable financing. And really, this is the idea that grants are not there to provide a permanent subsidies to private investors, but like, could they be used as a temporary bridge financing. So then that private investors can play a larger role and they take on the funding needs that currently might be taken on by a donor. And the example for example, in the India projects, and I'm sure, Stevie, you have 1,000 more, is like you could easily use this just a straight grant to help us put together women's producers, traders, and help them for 3 years. But then what? If you don't link that to what, then they go and raise capital from the markets. And usually that's where a lot of pilots, by the way, kind of like falls through. It's about the next wave of financing. And are the cooperatives ready to go and access a loan from a bank? So if we can use a grant to do the same thing, provide technical assistance, but create a link with the financiers, for example, by providing a bit certainty in the deal, like you were talking about, Sashi, enhancing their interest rate for a couple of years. I'm not talking over an extended period of time. Then they are able to better assess the risk in that portfolio, and ideally, again, that's the thesis, provide that capital at that cost from year 5 on. So it's really this role about you can use the grant, but then the question is, and a lot of models do struggle with replenishing every 5 years over grants and ODA, particularly in the UK and in other markets, that is shrinking. And so it's about where can you shift and use this grant to play a role so that then the investors, a big chunk of those development needs are taken care of by the private sector from then on.
Yeah, thank you. I like to refer to it as, supporting inclusive investment versus allowing extractive investment. And I think if more and more donors have a role to play in encouraging models of inclusive investment, then we do shift this power dynamic. And then we have investors like what happened with Stevie, where they are comfortable taking a lower return. I did also want to ask Serena if you can share your paper that actually goes into this a little bit further and how you believe there is room for us to engage with investors on reducing their expectations of returns and elongating their tenors of investment. My next question I was going to ask is to Fabiola, if you could share a little bit based on your research on climate finance, what else do you think is needed to unlock catalytic capital from family offices, foundations, development finance institutions, and other partners aside from a partner like USAID?
Yeah, thank you. I do think that is a bit of the vision, right? How do we make this type of investment the mainstream? And I do think there's a lot of ways. We're still at the process of learning, and we need to do a bit of education, showcasing more examples, capturing the lessons, what worked or what didn't. I do see, at least in the Latin America ecosystem, family offices and foundations looking to start using the resources different, right? Moving away from the traditional way and approaching actors like the SBX and other organizations to understand, okay, how can I go maximize my impact? How can I mobilize capital? And one of the mechanisms that we mentioned is creating some of the structure is complicated, right? And I think maybe those actors will be less willing to go through that process. And I think it's the opportunity of facilitating that matchmaking, coming to them with something that they can understand, where there is evidence, where we are able to collect the data and show kind of what will be the impact, what will be the resource, what is the opportunity for different levels of returns in some of these activities. So I do think there is a lot of having more success cases, disseminating, capturing the lessons, iterating, and also pulling them in and crowding them into things, even though in some cases the development agencies are better set up to go through the process of financing the project preparation. I think how many times we've heard about there's not enough funding, there is not enough projects, and just facilitating that match, especially as they start making their first investments in the space, I think will be very important. But conversations like this, and I know there's many forums in which we're starting to have this conversation and bringing them into the table, are very important.
Agreed. I would ask if you could also drop the link to the case studies that you all worked on, as well as the learning brief for everyone on the panel, for everyone in the chat to see. And then just to reiterate a shocking statistic, only 2% of philanthropy is dedicated to climate work. So, I mean, if you think about that, then we have a long way to go in terms of getting more foundations to work in this space. I think we only have 6 minutes left, so I was going to ask the last question to Stevie. We've had a couple of questions around, how we get financing to indigenous populations, but I also wanted to give you a minute to share a little bit about, adaptation finance and the challenges around that. So with that, I'll turn it over to you, and then we'll do a wrap up.
Sure. And I think Serena's presentation also mentioned adaptation, mitigation. And so I think we have a lot of environmentalists who are well more prepared than I am. But this idea with adaptation is that we're adapting to the new realities that our climate is presenting for us. So with coastal ecosystems, that could be with the rising sea levels, that you're providing some sort of protection for the coast. What we're actually seeing, and I'll give a very specific example, in Mexico for adaptation, is talking to cooperatives that are working in Oaxaca that they grow coffee, among other things. And that's another thing that really be important when we're thinking about regenerative agriculture, climate adaptation in agriculture is many producers are producing more than one thing. That monocropping, and at least in Mexico, happens, absolutely, but that we need to take into account this diversity of crops in order to actually do adaptation mitigation as part of the thesis with Regenerative Ventures. But anyway, going back to Oaxaca, what we've seen is due to the changes in the climate and the rains, producers are needing to move their current coffee plants up about 200 meters, or what's happening, and this is a shout out to our implementing partner, Conservation International, they've actually received GEF financing, so the Global Environmental Fund, for adaptation measures. So they're actually using that grant financing to renew coffee plants and to change the species so that they're more adapted to the, in theory, more arid conditions of Oaxaca, and in terms of not, instead of moving their land because they might not have land 200 meters higher than where it originally is. Where there are challenges is that's a different pocket of money. And I think that's always a challenge with donor financing, is if one pocket of money goes to one thing and one pocket of money goes to another thing. And it's really difficult to combine efforts. That's what's so important for the NGOs and the implementing partners, in my personal opinion, is we can take that GEF money where cooperatives are able to replace their coffee plants given to the new conditions, and use that as sort of a basis for that same cooperative to get financing through the blended finance engine. So in that case, actually, one of the cooperatives that's part of the GEF program is currently passing through the blended finance engine right now, where we're running their numbers, understanding what their full financing needs are, and finding the right debt for their needs. And so we're combining those different types of grant financing for adaptation with the debt capital. The investment thesis for Regenerative Ventures brings that all together into one fund. So we hope that in the next few years, we'll be able to share some more success cases with that.
Wonderful. Thank you so much. And thank you for your extended presentations, everyone. It's been really interesting. I feel like we could talk quite a lot longer, and for all of the audience members, engaged discussions and Q&A and the rich discussion happening in the chat box, that will be saved. And as Meredith mentioned, we'll be posting this recording on the Climatelinks website, along with, hopefully we can get the chat in there as well. And then you'll see a lot of the resources that we just provided would be also provided under the presentation link, so you can come back and read more about these projects as they develop and grow. It will be great to hear more on how you continue your work in Mexico and in Green Invest Asia. I think just to conclude, I wanted to just share that, as we talked about catalytic capital, it's just one of many tools in our toolbox. And this is something that I just want to highlight that came out in Administrator Power's speech recently as well, that USAID is asking our partners to think carefully at all the tools we have. And many of the models we discussed today is shifting to a model that's locally led and ceding power over decision-making to those who know their problems best. And so if we do want to shift this power structure of development, it will mean shifting the cultures within our own respective organizations and thinking about what is needed to empower those people that we're working with. And so while we talk so much about climate finance as something about achieving scale and getting private investors and equity partners into the table, it has to be done in a way that allows us to bring finance to the communities that need it and benefit. And that's going to be one of our biggest challenges, I think, as a community to solve. And so this is also meant to be a presentation where we say we don't have all the answers as we shared. We have some examples of what can be done, but we really don't have all the answers. And we're looking to you all to help us on how we can do more analysis, how we can develop structures that benefit communities and provide technical assistance and catalytic capital at the right time to have impact. So with that, that concludes our webinar today. And thank you all again for joining. And we look forward to hopefully checking in with everyone again in a year or so.
Thank you.
Thank you.
Thank you.